IRS Cancellation of Debt, the rules and exceptions. While it may seem like a good idea to negotiate that credit card balance down to a lesser amount, beware of the possible tax consequences that can hit you at tax time. Watch my next show to learn more about the cancellation of debt, and watch all the way to the end for my tax tip of the day.
Welcome to this episode of Accounting and Tax Tips, Smart Strategies for Small Business Success, with certified public accountant Tina Moe.
Many Americans were hit very hard over the last several years due to the recession that began in late 2007 and officially ran through mid-2009 and possibly longer, according to some experts. America hit record highs in unemployment levels and personal bankruptcies, but not everyone filed bankruptcy and instead opted to reduce their debts by working out a debt cancellation plan directly with their creditors. Unfortunately, unbeknownst to the taxpayer, they created a taxable event called cancellation of debt income. According to the IRS, a debt includes any indebtedness, whether you are personally liable or liable only to the extent of the property securing the debt. Cancellation of all or part of a debt that is secured by property may occur because of a foreclosure, a repossession, a voluntary return of the property to the lender, abandonment of the property, or a principal residence loan modification. Basically, if you're liable for a debt that is canceled, forgiven, or discharged, you will receive Form 1099-C, and it must be included in gross income unless you meet an exclusion. And if you receive this Form 1099-C, but the creditor is still trying to collect from you, then the debt has not been canceled and you do not have to include it in your income. There are some exceptions to this rule. For example, if you file bankruptcy and the debt is discharged in your Title 11 bankruptcy, you do not need to include this amount in canceled debt income in your gross income for tax purposes. Other types of canceled debt that qualify for exclusion include farm indebtedness, principal residence indebtedness, and debt canceled during insolvency. And the IRS offers a worksheet to help you determine if you qualify under these insolvency rules. Basically, it means you have more debts than the fair market value of your assets. But be sure to seek professional advice when taking this position on cancellation of debt. Now on to that tax savings tip. Did you know that saving for your child's college can generate a state tax credit? For example, the state of Indiana offers the College Choice 529 plan and offers a 20% credit for the first $5,000 or a $1,000 credit on your state income tax return. That's like free money. And you can do this annually, and your working child can contribute to the same 529 plan and get a 20% credit up to $1,000 too. That's like $2,000 free money. I'd call that a no-brainer. Be sure to check with your state tax department to learn more about the college savings credits available. For more information, visit my website at www.actservices-inc.com.
Thank you for watching this episode of Accounting and Tax Tips with Tina Moe. For more great information, visit Tina's website at www.actservices-inc.com. Also browse the other shows found right here at Indie Biz TV Shows.